Okay, I can see the numbers are starting to settle down a little bit, so I think we will just kick it off now. So good morning, everyone. My name is Haifa Khatib. I am a marketing assistant here at InfoTrack. Welcome to today's webinar, where we'll hear a review of the recent performance of the UK economy and how forecast recovery is expected to shape construction and real estate activity over the next 2 years. Taking you through today's webinar, I'm delighted to be joined by Ryan Cox, General Manager of Major Accounts, and Allan Wilen of Glenigan. Allan will be taking you through the presentation today. And before we begin the webinar, I would like to draw your attention to the Q&A tab, which is located at the bottom of your screen. We will be running a Q&A at the end of this session, so please type any questions you might have for Ryan or Allan, along with your name, into the Q&A box. That way, if we do run out of time or if your question requires further clarification, we will extract your information and follow up with you after the webinar. I'm now going to hand you over to Allan. Thank you. Okay. Take it away.
Good. Thank you, Haifa. Good morning, everybody. My name is, as Haifa was saying, is Allan Wilen. I'm the Economics Director at Glenigan. I'm just going to share my screen here. Okay, hopefully you can see the screen now. Okay. Okay, that's better. Right. Just clicking and it wasn't working. Yeah, so I'm the Economics Director at Glenigan, and Glenigan is a construction data company. We collect information on all of the construction projects that are coming through the development pipeline. We pick a lot of projects up at early planning. Prior to that, for example, we look at things such as the housing plans that and land identification work that's been done by local authorities to try and identify potential plots, and really track those all the way through the development process through to start on site. Anything over 10 units, residential units, or 250,000 will track right through to completion. The main benefit of that is for our members and subscribers, which includes a sort of a number of companies, including major contractors and leading property agents, is to really identify where potential opportunities are specifically for them. I use the data in a slightly different way. I use it strategically to really look at where's the pattern, the drivers, what's happening, how a particular market's moving, where the opportunities are likely to be occurring, sort of at a sort of a market level. And from that, on the back of that, we do a number of things, including provide our construction forecast, which I'm going to say a little bit about today, as well as bespoke work and custom research for individual customers. In terms of the forecasts, it's quite interesting times to be doing a forecast at the moment. We're currently working on our latest forecast, or we've completed the work on it, and that's due out at the beginning of November. So we've got a sort of 10 days to go, really, so 10 days, 2 weeks to go until we release that. Clearly, at the moment, a lot has been moving and changing. So whilst I can't give the individual figures at the moment for the forecast, I'll certainly be talking about what we see as driving the individual markets, to really give you an up-to-date feel for what we think is going to be shaping and as I say, really driving individual construction sectors and property sectors over the next couple of years. Perhaps it's useful to start with the wider economic background in terms of where the industry is going to be moving, and because I think it really helps to give a feel for where the industry, whether it's property or construction, is going to be moving over the next few years, and understand where we're coming from effectively. Certainly, I think we've had 4 successive economic shocks to the UK economy over the last 4 years. Not quite the 4 horsemen, but it's certainly economically it's felt a little bit like that in terms of Brexit, then the pandemic, and then the war in Ukraine and the sharp rise in energy costs and disruption we've seen on the back of that. And now, obviously, the domestic turmoil we're seeing at the moment, which is really making it quite difficult to see the government's own plans and how they're likely to shape out and hopefully drive the UK's recovery over the next couple of years. I think all of those shocks really have accelerated a number of structural changes that perhaps were already underway, both in the economy and particularly in the demand for property. And that's across a number of different sectors that seems to be at play. And I'll say a little bit more about that as we go and look at individual sectors in turn. Certainly going forward to the next couple of years, alongside that structural change, we are looking at a weak economic outlook. There's a good chance the UK will dip into recession next year. It is expected to be, at the moment, a sort of a shallow recession and relatively short-lived as well. Having said that, there's clearly some downside risks there. We've already seen a sharp rise in interest rates. And I think the political disarray has perhaps aggravated what would have been a rise in interest rates anyway. And that's clearly going to have a dampening impact on the property market and related construction activity as we go into 2023 and then through to 2024 to some extent. So how's the recent turmoil affected the property development and property sectors? Well, you can actually see a lot of that from just looking at some of the data for the construction industry that we gather. We do a survey, for example, for the National Federation of Roofing Contractors, and you can see that the big issue over the last couple of years has actually been the availability of roofing materials. This is obviously roofing materials for them, where they've just has been a major problem in securing the required materials to press on with work. And alongside that, certainly during the course of 2021, we saw a sharp rise in the cost of those materials. It peaked at around on a sort of a basket of prices that the government puts together. Cost of materials peaked at around 21% in January this year. We're starting to ease off a little bit, and then we saw another upward surge, really as the impact of the war in Ukraine and the rise in energy costs started to feed through as well. So the industry, construction industry, has been facing a period of supply chain disruption and a lack of availability of materials and rising prices as well. Similarly, you can see the supply issue there in terms of some specific materials. Again, these are government figures, and you can see that actually the availability of basic materials like concrete roof tiles and cement, RMC, ready mixed concrete, they've remained below pre-pandemic levels. So clearly there's a sort of endemic sort of shortages there, which are effectively acting as a brake on potential construction and development activity. Now that's had an impact on the construction process. And I think that's from a property development issue. I think that's of interest. We've seen quite a sharp increase, certainly over the course of the pandemic, and certainly as we went into the current year, in the time it's taken for projects to go through the sort of pre-construction development stage and get onto site. And then also there's delays in terms of the actual start to completion process as well. And I think that really reflects some of it, the actual disruption during the pandemic itself. But as we've come out of it post-pandemic, it's that availability of materials and the sharp price rises has prompted a lot of people to perhaps redesign projects, and that's delayed projects getting onto site, or just to do a reappraisal and saying, actually, what's the viability of these projects? Should we be pressing ahead with them at all? And I think that's going to be a particular issue as we go into the next year, into 2023, given, as I say, that deterioration in the wider economic outlook for the economy and the impact that potentially has on clients' business cases for investment, really. So that's kind of the wider economic background, and I thought it might be useful now to perhaps go and look at some individual sectors, starting with the residential sectors in a little bit more depth. So from a forecast perspective, We've seen a fall off in project starts during the course of 2021. After that sort of initial bounce back, during the course of 2022, after that initial strong bounce back we saw in activity during 2021. There's a number of factors for that, and I think primarily it's the change in economic outlook and conditions in the wider housing market. You can see this from the wider housing market data, such as property transactions and mortgage approvals, where we saw after the disruption during the first lockdown, we saw quite a buoyant housing market. It really came back incredibly strongly, driven by two factors. We had government measures such as the temporary reduction in stamp duty, which helped buoy demand, but that demand was already coming through. But it was quite focused. And I think again, it's coming back to this theme of structural change. In the pandemic sort of spurred people on to think, okay, what we really want, they put a premium on having more space, more access to open space, and that fueled demand in particular parts of the housing market, particularly in sort of large properties in more rural and market town type locations, at the cost of larger conurbations and high-rise and flat type apartments. So whilst we saw quite a sharp rise in activity and in house prices during that period, it was by no means has it been evenly spread across the housing market. Regionally as well, areas such as London, for example, have underperformed the national picture as a result of that. What we're now seeing is a bit of a cooling. We've seen during the current year is a cooling off. This is the sort of annual figures, but if you're looking on a month-by-month basis, actually the last few months house prices haven't been rising at all, or potentially weakening, and certainly RICS and others have reported quite a drop in potential market activity coming through in terms of the pipeline of properties that are being put on the market, in the wider market. So clearly a cooling in activity there. Factors that were driving things previously, like the increase in stamp duty, came to an end in the autumn of last year. We saw in the relatively short-lived mini budget reduction and another change to stamp duty, favourable change to stamp duty, which will within the wider mix be a positive particularly for first-time buyers and for new house sales as a result. But it's very much in the mix, and I think that's going to be really kind of overshadowed by the fact we're seeing much higher increase in much higher mortgage rates, and a much weaker economic outlook with a squeeze on household incomes. Real incomes are actually falling at the moment. That really is giving people a lot less spending power and making them much more hesitant about moving into thinking about major purchases, including house moves at present. So I think that's going to dampen overall housing market activity as we get into next year. But I think it's quite interesting if we look at the pattern of activity. I was talking earlier on about how we've seen that sort of buoyant demand after the pandemic, but I think there's been a longer term trend already underway there within the housing market. This is looking at the 5 years following the Grenfell tragedy, which also includes that pandemic period, but also prior to that as well. You can see that actually the demand and the increase in prices over that 5-year period compared with the previous 5 years was very much directed towards housing and away from apartments. And I think that really reflects the fact that actually a lot of people, the legal problems and the lack of demand as well following the Grenfell tragedy has really sort of put a cap on demand for those sort of properties. Something that has been exacerbated sort of post pandemic by people's increased demand for more room and access to open space. And I think it's quite interesting. So when you look at the overall development pipeline, you can see that strong growth over the last few years, but then quite a sharp fall off during the course of 2022 in terms of the value of projects that have been securing planning approval. And that will be a whole mixture of private housing projects, primarily build for home ownership, but there are also some build to rent within that sector as well. So you can see a strong growth there, and there's quite a strong pipeline of projects that could go ahead if the confidence is there for them, that developers can bring them forward. And I think that may be one of the factors behind the drop-off we've seen in sort of approvals during the course of 2022 is actually they're being cautious about their development programs going forward, and certainly sort of the recent reports from some of the leading house builders is that completions are the number, their sales of completed homes are substantially down on where they were just a year ago. So that it reflects that cooling in the wider housing market. So they're sort of tempering and drawing in their development activity. I think they're going to carry on pressing on, perhaps building out existing sites. Therefore, as a result of that, less interested in sort of bringing projects through the development pipeline and starting projects on site as well. Having said that, I think it's quite interesting. This is some data analysis we did just from last year, looking at last year and the run up to it in terms of the build to rent sector. And I think we're talking about the sort of the high-rise apartment sector really not being in favour with owner-occupiers, given the sort of leasing issues, insurance issues, and so forth. And actually, I think it's left open up as a bit of a opportunity there for the build-to-rent sector to come into that sector in more urban locations, and certainly having sort of tailed off in the run-up to both to Brexit and then during the pandemic. Last year we saw quite a resurgence in the contracts being awarded for major build-to-rent projects. And I think that trend is might have plateaued a little bit this year, but I think that sort of kind of sums up the trend there. I think going forward, I think there will be a little bit of, as I say, a little bit of tempering of development activity in terms of people thinking, actually, what's the potential demand and ability to pay rents and so forth near term may just temper development plans a little bit. But I think the primary driver for this is going to remain positive, and it's going to be very much, as I say, on the apartment side of things, really building on perhaps the experiences, different players, but the experience of the student accommodation sector, which I'll say a little bit about in a moment, where perhaps people who had been at university and living in halls of residence have kind of got accustomed to that model of living and respond quite well to the idea of having sort of supported facilities in sort of build to rent projects often offer. So I think that's going to remain a growth area. I think there will be some single unit developments going forward, but I think that the primary focus is still going to be dominated on apartments in major urban areas going forward. And then moving on to that student accommodation sector, where this has really been a growth area for a number of years, but we're now sort of entered a phase of consolidation. You can see that actually what's happened over the last year in terms of the chart on the right, in terms of the number of or the proportion of students that have been in halls of residence has been steadily climbing, and actually the share that have been in private halls, sector halls, has also been increasing. What we've seen perhaps over the last few years is there's been a bit of a dip, but also I think the share that have been going into private halls has been growing, where some of those institutionally maintained properties perhaps are either being sort of transferred into private ownership and refurbishment, or sort of come to the end of their life and sort of been retired. So I think that's going to remain a positive underlying support for the sector. But I do think it's going to struggle going forward in terms of the number of projects that are coming forward. And I think that reflects that whilst we've seen that strong rise in student numbers over the last few years, one of the key factors that have been driving that from accommodation perspective has been the rise in overseas students who typically will stay in those halls for all 3 years of their sort of graduate degree, undergraduate degree, as opposed to perhaps just what traditionally the 1 year that UK resident students will do. So, as I say, it's quite an important market for them, and I think that's going to face headway certainly over the next couple of years. We saw obviously a lot of disruption during the pandemic itself, but we've also got a sort of backlog sort of historic changes such as Brexit, which is sort of dampening the demand from EU students, for example. And then there's global factors which may also dampen the sort of the number of students coming over from places like China, which is again has been a major driver for overseas student numbers. So as a result of that, I think as I say, we're in a bit of a period of consolidation there for the student accommodation market, which had grown really strongly up to sort of 2018, and then, as I say, it's been entering this period of consolidation. Yes, it's going to move off the lows we saw and the disruptions we saw during 2020 and 2021 over the next couple of years, but it's going to be quite gradual growth, really bringing it back up to the levels that we saw in 2015 before the recent sort of surge in project activities we saw prior to 2019. So perhaps moving on from just to quickly summarise on the residential sector. So we saw a rebound in activity last year, and whilst there's still a potential strong development pipeline, I think the conditions in the housing market and the squeeze on household earnings from rising taxes and interest rates and inflation will overshadow the housing market this year and hold back activities are going to 2023. Hopefully we'll see a brighter picture coming forward as we get into 24 and conditions look more positive for the wider economy and for household earnings, and we'll see developers actually bringing more projects forward. Alongside that, we've seen renewed growth in the build-to-rent market, which is a positive, and also consolidation, but perhaps gradual growth in the student accommodation sector as well over the next few years. And turning to the industrial and commercial property side of things, in terms of new construction activity, sort of a relative positive picture. Certainly this year, continued growth on where we were in 2021 in terms of the value of projects starting on site. And overall, relatively stable in 2023 as well. So on the face of it, it's relatively positive, but within that, some real structural changes going on, which I think is going to be quite interesting, and will throw up new opportunities in terms of lettings and transactions as we go forward over the next few years, as well as construction development opportunities. I think one of the factors that's driving things has been the change in consumer spending habits, both long-term but also disrupted during the pandemic, and how that's likely to play out now over the next couple of years. We've seen sort of a progressive rise in more and more of our purchases being made online, and you can see that strong market share there that's grown, grew steadily really to 2020, and then we saw a big surge in people purchasing online during the pandemic, and a lot of people who hadn't sort of gone down that route were sort of exposed to that for the first time during the pandemic. Obviously, retail sales generally were weak as well, so that helped to boost that market share. But you can see from the chart on the right, though, actually we saw that strong growth, and it has weakened sort of post-pandemic, particularly over the last year. And I think that's quite interesting, really, in terms of actually it's moved back. In fact, it's dipped below perhaps its longer term trend of late. And I think there's a number of factors that are to shaping that. Not least, I think, is the squeeze on household incomes, which is perhaps hitting people's discretionary spend, and And in terms, you can certainly see it from the mix of retail sales on the chart on the right there, that actually things such as grocery has remained relatively stable throughout the pandemic and subsequent to that in terms of retail sales volumes. But it's, as I say, it's nevertheless perhaps slipping back at the moment because of that squeeze on households' incomes and spend. But other areas, such as clothing and footwear, for example, which is more discretionary, that actually has fallen away of late. And that'll have knock-on implications for a lot of the online retailers as well. Certainly Boohoo, for example, has been warning for much more difficult market conditions of late. So I think what's happening is people actually, when they are spending, are being more particular, more price conscious. And I think that might have had an impact in terms of where they're shopping as well. And certainly if you look at the sort of the retail construction side, we can see that in terms of where the demand is coming from for new retail and improved retail facilities. Demand has fallen away. It was already on a downward trend prior to the pandemic, very much being driven, say, that long-term structural change that was already underway in terms of more and more purchases being made online. We saw a sharp fall during the pandemic, which saw quite a recovery in 2021, but that sort of has petered out during the course of this year, and we expect this sector overall to be relatively subdued over the forecast period in terms of new and refurbished and extension work coming forward. The one bright area within that is on the supermarket side in particular, are very much driven by investment by the deep discounters. Aldi and Lidl have got substantial investment plans and are looking for opportunities to open new stores and locations for those stores. And I think that that has been and is expected to remain an important driver for construction activity within the sector. But I think it reflects actually where the consumer demand is at the moment, that actually even the major supermarkets have been losing market share to those deep discounters, and I think that's going to remain a pressure at the moment as everyone becomes very price conscious and is looking for cost savings, certainly over the winter, but going into 2023 as well. So I think that's got an overall dampening impact both on retail activity, but also potentially, as I say, on the internet side of things, where again any discretionary expenditure, perhaps online purchases as well, will be subdued as people perhaps getting a bit more conscious, want to actually go and see, go for a smaller shop and see what they're purchasing. It's interesting, I say, a lot of the convenience store side of things, for example, is also does relatively well in these sort of circumstances because people are being price conscious and wanting to do smaller shops. So those small local stores, a lot of which have also been rolled out by the major supermarkets as well over the last few years. They're probably better placed than the larger stores where they can be suffering from footfall, particularly if you've got to drive to those sort of locations well, and there's a cost of associated with doing that as well. So I think that kind of underlines the shift we already saw in terms of location for retail premises during the pandemic. One of the things that happened there is because there were more people working from home during that period, demand fell away in major retail central retail locations such as major city centres, because they weren't getting the footfall from either from, in the case of London, from tourists, but also from people working in offices and other facilities during their lunch hour or after work. So as I say, but on the flip side, local shops were benefiting, so that's throwing up new opportunities there as well. The flip side of the trend to online has been in the demand for industrial premises. We've seen strong growth over the last those couple of years in terms of the value of projects starting on site, both in terms of the underlying market, but also the larger, really large projects, the 100 million plus projects. And the development pipeline, as you can see from the chart on the right, has grown even more strongly. So there's plenty of projects there that are potentially in a good position to go forward over the next couple of years. And that demand has been very much driven by the need for logistics space primarily to support that online transition that's underway. And that takes sort of a number of forms. Obviously, you've got a major logistics centres, particularly in places such as the Midlands, parts of the Southeast, the Northwest, alongside our major motorway networks to allow major sort of national distribution from those premises. But also across the country, particularly around the sort of urban fringes, there's a demand for facilities to support the final mile delivery to people's homes, and that's sort of a major growth area as well, with sort of repurposing perhaps and reimagining of existing industrial units, as well as investment in new industrial premises. So refurbishment, change of ownership going forward in those sort of locations. For example, Ocado are taking on smaller units really to help then sort of facilitate the delivery to people's homes within sort of a few miles radius of that relatively small location. There's one near us, for example, that was a former home base that's now a distribution facility for Ocado. And I think that has been the major driver behind on the industrial building side for industrial starts, which had been on an upward trend prior to the pandemic. We've seen a surge in new starts both in 2021 and the current year, both in terms of projects that we've identified as being warehousing and logistics, and what we more widely called manufacturing. But these tended to be light industrial units within the manufacturing sector. It's been the main growth area there. And I think that reflects the fact that obviously those sort of premises, they might be, we might register them as light industrial, but they can be easily turned to the logistics side of things as well. In terms of overall manufacturing outlook, I think the prospects there are less positive for major industrial investment. Domestic demand for manufacturers, both demand overseas and in the UK, the outlook there looks weak long term. Clearly, there's the sort of Brexit issues as well that are overhanging that, alongside the weak global economic outlook. So I think that's going to be a dampening influence on terms of investment from manufacturers. But against that, strong demand, as I say, for distribution facilities, and a lot of investment going on there. And whilst there's been a general weakening in sort of property, in a number of property sectors, actually there's still quite strong yields and sort of rental prices being secured for warehousing facilities at present. Moving on to the hotel and leisure sector, which again, it has been buffeted over the last couple of years. There's a strong development pipeline in this area as well, but clearly the hospitality sector has been really hard hit during the course of the pandemic. It's probably the one part of the economy that suffered the worst and for the longest, with extended restrictions on their opening and closures to their operations. The hotel side of things, for example, was also hit hard by the collapse in overseas visitor numbers over the last few years, and that's supposed to be expected to be a gradual recovery rather than a surge in visitor numbers over the next few years. So again, that's going to have a dampening impact, particularly on those parts of the market that are particularly geared up for overseas visitors, such as the capital, for example, and some other parts of the country. Whereas actually some other sectors, parts of the sector, benefited during the during the pandemic as more people chose to holiday in the UK rather than travel abroad. So that provided a little bit of a fill up, but obviously as we go forward into the next few years, again, we might see a bit of a retreat there as more people do look to try and take overseas holidays again. Alongside that, this sector is also very dependent on discretionary spending by consumers, and whether that's in terms of nights out or, as I say, holidaying in the UK, or just sort of weekend breaks and things like that. And all of that, I think, is particularly vulnerable over the sort of the near term from the real strong squeeze we're seeing on household incomes, which means a lot of households are actually prioritising sort of food, heating, and those sort of things, which leaving less in the budget for discretionary spending going forward. So alongside that, obviously, a lot of operators also facing a sharp rise in energy and other costs themselves as well, which again is putting a squeeze on their financial position. So as a result of that, we're very cautious about the prospect for the sector going forward. We've got a gradual growth in 23 and 2024 in terms of new projects coming forward. I think really owners are going to be very much looking at actually trying to secure their own financial position, look at their own financial circumstances and balance sheets, and that's going to have a dampening impact on investment, particularly given obviously the potential cost of that investment in terms of interest rates is also on the rise too. Moving on from that to the office sector, which again is a sector that's being driven very much by structural change. London still dominates the overall office market in terms of both existing premises, but also in terms of the development pipeline. As you can see from the chart there on the left, that in terms of project securing planning approval during the course of 2021 and the first 9 months of this year, London still dominates. In fact, we've got a strengthening pipeline in London compared with other parts of the country during the course of this year. But I think it's interesting if you look at actually what's been happening within the office market as well. I think there's a lot of structural change going on there. The chart on the right really looks at the type of projects that are being brought forward, and this is in this particular chart I've included all projects, including ones over 100 million. So it includes some big major projects too. And you can see that actually there's been a sort of general fall off in new build projects. We saw a pickup sort of immediately during some big projects actually in the capital started during 2020 and 2021, and those will continue to flow through. So they'll be adding to new supplies. They're completed as we get into 2023. But within that, actually, the real sort of change in growth has been away from the new build sector. It's been in terms of extensions and refurbishment, and I think that really reflects changes in the way where people are looking to use their office space, and that's going to throw up new opportunities within the property sector over the next few years, because there's going to be a long-standing sort of driver there. We saw much more hybrid working, enforced hybrid working effectively, and remote working during the pandemic. And that actually was one of the factors that actually prompted that move away from in the private residential market, and strong demand for a support of that strong demand for sort of larger premises further away from major conurbations. The fact that people thought, well, actually, if I'm going to continue working remotely or hybrid working, actually I can put up with a more infrequent commute for a longer distance, and that sort of shaped the demand there. But it also obviously the implication of that is actually, whilst we saw that initial post-pandemic surge in new build projects, I say it's the structural change that's going to really reshape things going forward. where people would question the sort of clients, sort of in terms of occupiers, really question the sort of the amount of floor space they need, its layout, and its location. So, and that has particular implications, I think, for major urban areas, such as obviously London, but the other major sort of regional centres as well, to a certain extent, in terms of actually, if you're a major company, how much floor space do you actually need if half your staff at any one time are working remotely? How do you manage it so actually you're still getting people to come into the office and collaborate, and effectively have that benefit, but you also got to then manage that as to when different people are coming in to manage that collaboration. So what we've seen is a lot of refurbishment projects coming forward over the last year, and I think that's going to remain an important driver going forward, where companies are sort of reassessing the amount of floor space they need, perhaps decreasing it, subletting some of that space, and then redesigning the remaining space, so really that they've got a much more collaborative sort of environment, rather than just rows of desks for people to come in and sit at and get their heads down and work. That element increasingly will be done perhaps remotely. And another factor I think that's going to be continue to drive the sector over the next few years has been the move to, measures to support the move to net zero. I think that's helping to support the demand for premium office premises. One of the things that we look at is the BREEAM rating for projects, and we've certainly seen that there's the office sector remains an important area there in terms of projects that are coming forward that have a BREEAM rating, and increasingly they're going for higher ratings as well. So I think very much those sort of premises can command premium rents and tend to be in high, it's a high sort of profile projects in prime locations. And I think that the demand for those looks pretty firm going forward. But alongside that, perhaps we're going to see, particularly as a result of the effectively downsizing in requirements, the retirement of a number of projects. So that's going to drive turnover in the market, exacerbated and perhaps accelerated by the fact that we've got the EPC ratings coming in there, where actually there's restrictions on the minimum levels of energy efficiency on premises before you can let them, which have already come in, and they're going to continue to be uprated by 2023. So I think that will drive either it will drive turnover in the market, but perhaps also improvement and maintenance work to upgrade those properties, or potentially the repurposing of those older properties, perhaps the conversion to high-rise apartments, for example, which was something that we saw a few years ago as well. This could be sort of a second boost on that side. So hopefully that gives a good overview of where we see things going over the next couple of years. As I say, some economic headwinds at present that are really going to impact both in terms of the residential market, but also those key non-residential sectors, whether that's industrial through to retail and office space, really being driven by sort of the tightening, the poor economic circumstances, but alongside that, some real structural changes, which is going to throw up a lot of opportunities in terms of logistics space, refurbishment and subdivision of office accommodation over the next few years. I think I'll pause at that point and then perhaps open up to wider questions. I haven't talked about things such as the government sectors and things like that, for example, but I'm quite happy to sort of give my views on those as well.
Thank you, Allan. We'll just give people the opportunity to put some questions in the Q&A. If you don't feel comfortable asking any questions right now, then we will follow up with those. Feel free to reach out to ourselves at InfoTrack, and we'll be sure to pass those questions on to Allan get the responses and answers for you. Allan, thank you again. That was really, really informative. I think as we said at the beginning, we haven't done the presentation for a few years. It's really great to see what you discussed just prior or at the start of the pandemic, and sort of seeing the forecasting and fell aligned with what you gave, the information you gave then. A lot trickier at the moment with the current climate, but hopefully that also gives the people on the call a really good idea and understanding of which clients and which areas to try and promote within your client base currently, and where you sort of can see the opportunity to grow in what could be quite a tricky market conditions over the next couple of years.
Yes, that's it. I think that's what I was trying to sort of touch on really, because I think, yes, if you look at the wider economic picture, it is, it's tricky. It's a difficult market conditions in terms of the wider economic pictures, but you've also got that structural change that's coming through, and I think that throws up opportunities. The office sector is a good example of that, where actually you might face, actually we probably don't need all this office accommodation because of everyone working remotely. Well, actually that throws up opportunities where actually stuff is going to be redesigned, sublet, perhaps repurposed. So all of that, I think, is sort of throws up a lot of opportunities for companies to perhaps target going forward.
Absolutely. I don't think we have any questions. So again, I'll thank you very much, Allan, for your time. You can see there, guys, the email address and contact number should you want to raise any questions after this. Really appreciate your time today, Allan, and Haifa, for arranging this as well. Hopefully we'll hear from you soon. Allan, again, thanks again. Have a great day, everyone.
Okay. Thank you.
Take care. Thank you.